Let's face it, most traders are very uninterested in higher time frames. They're too slow, boring, and they much prefer to trade lower time frames. The main reason for this is because on lower time frames, the markets are moving like crazy, and this, to the new trader, signals many trading opportunities. The biggest thing the same traders are failing to notice is that while there are plenty of opportunities on these very small time frames, there are also many more false signals that will wipe them out. The smaller time frames can prove to be effective, but they are also notorious for eating up traders' accounts because of the pace they move and how erratic the moves can be. This can make it especially hard for the newer trader trying to learn how to trade effectively. So the best thing to do if you are trying to learn how to become profitable is to trade signals of the daily chart. This will allow you to have the time required to make informed decisions. Many traders will find this hard, but they might also continue to struggle to make money until they make the change. Of course, you don't have to always stick to the daily charts, but if you are losing many trades, I highly suggest giving the higher time frames a go. Once you have become profitable using the higher time frames, you can then consider moving down the charts. The transition to the daily chart is hard, and the majority of traders are reluctant to make the switch because of some misconceptions or myths. So let me alleviate some of the concerns you may have about trading on the daily chart. The first misconception I hear all the time is that higher time frames are not as profitable as lower ones. The majority of traders, especially the newbies, are so focused on short-term charts because they have entered the market with the wrong mindset. Many traders believe that if you put in the hours staring at the charts, you will get the returns. Like in real life, if you put the extra overtime at your job, you will generally be rewarded for your extra efforts. The financial markets don't work in this way. In fact, it's the opposite. You heard the expression, work smart, not hard, right? Well, trading the daily time frame is exactly that. When you're trading in an environment like the 1 minute or the 5 minutes charts, you're risking of trading market noise. Granted, the longer time frames won't roll out trade setups at such a high pace, but the signals that are generated on the daily time frame are much more reliable and have a much better chance of working out. It's the whole quality versus quantity argument, and quality is more important in trading and investing. It's better to trade a handful of high quality trades rather than trying to trade lots of poor quality ones. The daily time frame offers more clarity by providing the bigger picture. It's easier to identify the core price movements and get a much better read into the market psychology on the daily chart. You will be able to read the market much more easily than reading the lower time frames charts. At the same time, signals on the daily time frame contain more value as good trading opportunities because they contain more price data within the signal. Also, signals on the daily time frame are allowing for a better chance to hit a higher risk-reward on your trade. The second misconception is that the daily time frame is too expensive to trade if you have a small account. This is wrong. Your account size doesn't determine what time frame you should be trading. All this speculation flows from the idea that the wider your stop loss, the more expensive the risk. It's true that your stop loss will be wider when you work with trade signals derived from the daily time frame, but the moves you will capture are just as large. Traders who believe that the daily time frame is too expensive to trade simply don't understand how to calculate position size correctly. It's possible to risk $100 into a 10 pip wide stop or a 100 pip wide stop. They're just numbers. You just need to be able to work them properly. It doesn't matter if you have a $100, $1,000 or a $10,000 account. If you understand position sizing, then you can trade off the higher time frames with ease. Another misconception is that the longer you're in a position, the higher the risk. There are many traders that will push the idea that being in and out of the market is less risky than holding positions on a longer term. The reality is you're always going to be at risk of being stopped out from unexpected market events, no matter what time frame you use. In fact, you're more likely to be stopped out from intraday volatility when you take lower time frame setups and use small stop losses. The daily chart does a good job of filtering out this intraday noise, providing you with more reliable data to base your trading decisions. Most daily timeframe setups are hardly unaffected by the intraday volatility that affect the short-term traders. Lower timeframes are exciting, yes, but you also require to be at your computer and monitor price movements for many hours. Most short-term traders initially love the thrill and the action the fast-paced charts provide, but it's only a matter of time before you experience mental burnout. Once your mental discipline runs out, greed, frustration, anger, and impatience will start to trigger bad trades, sending you in a dangerous state of mind that is hard to bounce back from. The daily time frame sets you up for better success straight away. You only spend a fraction of that time in front of the charts, so you're at less risk of experiencing trader burnout. It's going to be much easier to keep a cool head while maintaining your mental and emotional discipline. Another misconception is that positions are dangerous to hold overnight. Now the markets are opened 5 days a week, and the forex market is open for 24 hours. It's fair to say that holding positions over the weekend can be a little risky if your position is fresh, due to unexpected weekend gaps from high-impacting global events. But there is no benefit to closing your trades at the end of the day. In fact, you could actually be shooting yourself in the foot by closing your trades too early. It's not uncommon for trades to take 1 or 2 days before you can see the breakout move from the setup. Have a look at this bullish rejection candle captured on the daily time frame around the weekly pivot point. The market stalled for a few days before shooting to the upside. This is a good example of why you need to be patient and let the market do what it needs to do. Closing before the end of the day would have ensured you were left standing behind, regretting a lost opportunity. I know it would be great if you could enter a trade and the price proceeds to shoot off like a cannonball, hitting your target straight away. This will occur sometimes, but you shouldn't be relying on it happening too often. The reality is, some trades may dip into the negative territory once or twice before maturing into profit, and this dipping in and out could span over a few days. You need to give your trades a chance and give the market the opportunity to do its thing. Don't cut yourself short by closing your trades at the end of the day. The fifth misconception is that price movements on the daily time frames are hard to predict. This comes from the everlasting dispute of technical versus fundamental analysis. They are a part of traders who believe technical trading is only effective on the lower charts, and that having a good understanding of fundamental analysis is needed for the daily time frame. You don't have to be a financial analyst to be able to follow long-term movements. All the data you need is displayed via the footprint the price leaves behind your chart, and that is the candlesticks. Technical analysis works extremely well on the daily chart, probably better than it does on most other time frames. The noise generated and the erratic price movements on the lower time frames will affect your technical analysis, hinder your ability to read the chart, and potentially rush you into many false signals. Thanks to the clarity the daily charts brings to your screen, the good trading opportunities are easier to be identified. So if your strategy isn't working on lower time frames, you're in a losing streak, or you may feel that the market is ahead of you and goes against you every time you make a trade, try the daily time frame. You'll have nothing to lose. Just by switching over to the daily time frame, you're making the necessary corrections to begin paving your way to better results. And remember, work smart, not hard. As always, if you learned something new and found value, leave us a like to show your support. subscribe to our channel and hit the bell icon to stay in touch when we upload new videos. Until next time.